Welcome back, everybody, to Magnolia on Money, where we discuss everything financial from the economy to retirement. I'm Ed Cox with Magnolia Wealth, and I'm glad to be back. Forrest did a great job last week explaining ESG investing. If you missed it, you should go look at it. It's really good. Did want to also tell you that we believe we've gotten our email issue fixed on sending out the videos via email. They've been on Facebook, and they're always, you can find them on our YouTube page, Magnolia Wealth TV. But this should come to you via an email as well. So we apologize for that. But if you did miss some of those and weren't able to see them through Facebook or directly going to YouTube, you can, when you click on this link and go to our YouTube channel, you can go back and view those other videos. So hopefully we got that fixed. If you are having problems, just call the office and hopefully we can help you get those situated. This week, I wanted to touch on a few new information, a little bit of information that we're getting on the economy and how it kind of points maybe to a short recession, if we have one, and how that could affect how these numbers and data that we're getting could affect the length of that recession if it does end up materializing. So let's dive in. I've got a couple of things that I think will be beneficial. So the first is earnings. I went through this, I think it was 2 weeks ago. And at that point, I believe about 70% of the S&P companies had reported. Now 85% of S&P 500 companies reported. And in the first quarter, 79% of those had positive earnings per share, which is great. That's really, really good. As a kind of a benchmark, you can see there that it beat the 5 and 10 year averages that we've seen in the past. 77% of the S&P 500 companies over the 5 year were positive earnings per share, and 73 over the 10 year. So that's really good news. Really, really good news that companies are still showing good profits, still their earnings are good, which is going to show in the stock market, or should show in the stock market with positive gains. The other thing that we've really been watching closely, and the Fed has really watched this closely, is the labor market. And in April, we saw another 250,000 jobs, which exceeded what we thought, and it really surpassed what March's were at 165. So almost 100,000 more jobs last month were added. So that's good. So the unemployment rate fell to 3.4, which is again the lowest level since 1969. So we keep building this case that, you know what, it looks like the economy is very strong. We have a really good, strong backbone in the economy going into possibly slowdown recession time period. But right now things look fairly good with some of these numbers and data that we're getting in. Let's touch on the Federal Reserve. Last week, 2 weeks ago, they raised rates 0.25%, and that brought the Fed target range to around 5 to 5.25. But and I highlighted this, the interesting part about the post-meeting statement that we did not hear, that we did hear back in March, was that the committee anticipates that some additional policy firming may be appropriate. So they didn't say that this time. So that may be suggesting that the tightening cycle is coming to an end. We don't know that. We're kind of reading into what the Fed's words are, and that's kind of what the market does. They really dig into what they're saying after the meeting. That's nice not to hear that. So we'll see if there's any teeth to it, but very interesting that was not stated in this Fed meeting. And then overall, let's look at the market. So this was as of last week. The S&P was up 8.3 year to date. Let's see. Look at the. You can look at some of these others: the Nasdaq, the Dow Jones. Bond returns were up about 3.5% year to date. So we're seeing good returns across the board on the market, and that's really welcome news for us. So I hope this helped and give you a little bit of insight into, maybe why the market has done fairly well this year so far. A lot of people, when we look, when they come in, we're looking at their year-to-date returns, are surprised that, I thought we were doing really bad. I thought the market was really bad. And if you listen to too much news, maybe you get that sense. But we've done fairly well so far in the market this year. We're hoping that things will hold up, and we're hoping that these strong numbers and the economy's backbone is strong enough to withstand maybe a little bit of a slowdown as we come into the summer months. But I hope that helped. Y'all, as always, have a blessed week, and we'll talk to you next time. Take care. Bye-bye.